Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Steve Maldonado. Steve is a student of finance from the University of Central Florida. Steve has applied his knowledge to a career in sales and business development, working with and building teams to adapt a new market trend in the alternative asset industry. Becoming an expert on retirement accounts, Steve has used his industry knowledge to move into his current position as the Director of Syndication Solutions at NewView Trust, a premier custodian for self-directed alternative investments with over $2.5 billion of assets under management. Steve also has a passion for charity and regularly donates his time to the community, participating in projects for Habitat for Humanity and sharing the Sharing Center, as well as volunteer in Florida. So, Steve, I appreciate you being on The Wealth Flow and looking forward to diving into to your story.
Yeah, likewise, Keith. Thanks so much for having me on. I'm excited to be talking to you and the rest of your tribe a little bit about how I got into the world of alternative assets and also how self-directed IRAs have really helped accelerate my retirement growth and the lives of so many of the other people that we've connected with. So thank you.
Yeah, absolutely. Why don't we start with this, though, Steve? If you can just kind of give us an idea as to where you grew up and what eventually led you into this space.
Yeah, great question. And I appreciate being able to share my story. Well, I grew up in South Florida, Fort Lauderdale more specifically, in a home with 2 parents and 3 siblings. In that home, love was abundant, but luxuries, well, those were hard to come by. We worked for everything we had. And, my parents always instilled a really good work ethic in us. If you recall those fundraisers selling, cookie dough or wrapping papers, I wasn't just participating, I was dominating them, right? I was, and by 12 years old, I was doing everything from offering lawn care to house sitting, really all under my entrepreneurial banner. And so my journey with money got started very young, but just like any other kid, had a lot of growing up to do. And with that came a lot of ups and downs. Fast forward, I was at a time in my life, I had graduated college. I was shortly thereafter, blessed with a son, and we were looking for a place to live outside of where I currently resided. Through that search, I got connected with a gentleman who not only provided me and my family a place to live, but was also able to mentor me on the world of alternative assets. He actually introduced me to NewView Trust, the custodian that I have the privilege of working for now. And it's been a 7-year journey of progressive learning and growth. And looking back on it, I am so incredibly blessed for that opportunity that gentleman gave me. And I'm very excited that it's now my job and be able to share that passion and experience with the rest of the world.
Yeah, that's interesting. That's obviously not the normal path of, getting into something. So this gentleman, I guess saw the situation you were in and just decided that he helped provide housing and not only that, provide, I guess, a place to work, huh?
Yeah. So like my bio said, thank you for reading that. I was a student of finance at UCF. Like I said, graduated, and really had some quick decisions to make. I was living in a house more suited for college students than raising a family, and so my need to move was again a need, right? Not a desire, but more of a necessity for myself and my family. And at the time, there really weren't too many options. We got connected through our church. He's another parishioner at the church. And anyway, again, to make a long story short, he took me under his wing. He kind of recognized the situation that I was in. He recognized, my ability to kind of learn quickly, but also that I was very curious. And that's benefited me tremendously. And we have a great relationship even till today.
Yeah, that's interesting. And so tell me a little bit about what you started to do, with him and kind of, was it right off the bat alternative assets, or tell us a little bit about that?
Yeah, so he started to explain, that he owned about $1 million worth of real estate, his IRA. He explained how he went on to maximize the money outside of his IRA into all forms of private equity, venture debt, or capital, all forms of alternative investments, and more specifically, how his portfolio allocation shifted to being traditionally focused, right? Stocks, bonds, mutual funds to shifting to more to an allocation of alternative assets. And this is a gentleman who spent, 30 or 40 years of his working career on Wall Street, in the big stocks, right there on the trading floor. But absolutely, my journey was all into alternative assets. So just like any younger person, or maybe not like any younger person, like some young people, I took the opportunity to learn quickly about personal finance, try to get, my footing underneath me. And so, of course, you come across the common things: put your money in indexes, invest in the S&P, watch your money grow over time. You're young, you can absorb risk, this, that, the third. So that's what I did. I indexed most of my money. I didn't really think about it. I saw consistent growth, and I thought that I was doing exactly what I was supposed to do. The light bulb really didn't go off until my eyes were open to the possibility that I can do something different with my money. And then, of course, my growth was accelerated by the fact that I didn't have to do a lot of digging, where a lot of people, have to do a lot of research and then execute. I was able to get this mentorship and really start executing a lot quicker than most people. And so you asked me kind of where I got started. My mentor opened my eyes up to the possibilities of buying real estate options, which works very similar to stock options, but you just apply that same concept to real estate. For any of the listeners that haven't had any experience with that, essentially it's purchasing the option to buy somebody's home or piece of real estate at a certain price, a certain strike price, within a certain amount of time. And you're betting on the appreciation of that asset over that course of time, and that fact that you would be able to acquire it, at lower than market value and then sell it quickly thereafter on the market, basically making income from the delta between what you paid the seller for exercising that options contract and then what you sold the property for at market afterwards. So it was a way that I could get into alternative investing with very little money, right? Because again, I was fresh out of college. I had taken on student loans. I was working full time to pay my way through school. And there wasn't a whole lot of extra money, coming through. I had a son on the way. I have all these, between security deposits and everything else. So essentially he, worked with me. He waived my security deposit for moving in here. And he freed up some cash for me to start investing in these options. He kind of opened my eyes up to where I can find distressed sellers that were looking for cash that would, potentially be where an options contract might be attractive for them. He showed me how to approach and write the options, how to really sell them. And that's how I got, my start. My first couple options were a bust. I think I spent $2,500 on the first one. The next was $1,500. And mind you, these weren't $1 million properties. These were small, cheap residential properties. But then my third one, I got it under contract, $5,000 option. That $5,000 turned into $50,000 in the course of 8 months. And that really accelerated my growth. I got super excited about that. I said, well, hey, what else can I do with my money now that I've got a little bit of a larger nest egg? And that gave me the opportunity to start doing some JVs with people in my local area and start acquiring bigger and better assets. Now I participate as a limited partner in other people's multifamily syndications and also have my own rental portfolio. And so, yes, it's transformed into primary allocation to real estate, but yeah, has been pretty much alternative assets the whole time.
Yeah, that's interesting. And I haven't necessarily heard the term option. And I've been in the real estate industry for quite some time, but that's interesting. So tell me a little bit more about it. Is it similar to wholesaling where you're getting a property under contract, or what exactly is that option? And usually how long between when you come to an agreement with the seller and how long do you typically have to be able to flip it to a new owner?
Yeah, so it really all depends on the situation, right? So you're looking for distressed situations. In my case, the option that made me the money was a widow, right? She had recently lost her husband. They owned their home free and clear. Her income that she would be receiving from Social Security and other regular payments wasn't enough to cover the property taxes. She had a need to move into another situation. She had money to do that, but not enough money to carry the expenses on the other property. I told her, hey, if I give you, X number of dollars, will that cover the cost of the property for the next year? She said yes. So I gave her that money. That solved her immediate issue to be able to move into, her new living situation, but also carry that property. I told her, hey, we're going to find, I'm going to find a buyer for this. This property will appreciate, but it's not exactly a wholesaling model. Essentially, I have the option to buy it or don't, right? I'm out $5,000. I'm not putting it under contract. I'm not looking to go, resell my option. I'm looking to exercise my option in an ideal world. I purchased this $5,000, or sorry, I purchased this option for $5,000. The home's valued at $100,000. In 6 months, the value of the home appreciates. Maybe the value is $150,000. I've already paid the $5,000 to execute my option. I can execute my option, purchase the home for $100,000. I go out and I get private money for $100,000. I put it on the market. I pay my interest only payments to my private money lender for
Mhm.
2-3 months. So that cost me, $1,000, couple $1,000. Anyway, I sell it at market for $150,000, take that money, and whatever the difference is what I was left with. So that's kind of how that worked. But no, there's not like another market for it. If I decide not to execute the option, I'm out my $5,000 and I just walk away from the deal.
Okay. Okay. Very interesting. It's fun. You always learn something new, and that's one of the things I love about just hosting this podcast.
Yeah.
Get a chance to hear a different perspective on things. And so, from there, you said you started to invest as a limited partner in some multifamily deals. Are these operators that you had a relationship with because of the self-directed IRAs, or how did you come about learning about that side of the business?
Yeah, so in a very similar way that I got to learn about the options. So once I had a little bit of a nest egg, again, I was able to start participating in other forms of real estate deals. And so myself and a partner did a JV on a couple properties in Jacksonville. So we own a quadplex, we own a sixplex, and we own a duplex over there. We also own two single family rentals here in Orlando. And so we acquired a small rental portfolio after kind of learning the ins and outs of what's required to do all of that. I wasn't too keen on being an active investor much more because I had other goals, in my life, and it didn't involve taking care of toilets and tenants. So somebody introduced me to the idea of becoming a passive investor in other people's deals. It seemed really great. I was able to participate in these real estate deals, see higher returns than I would in the stock market, but I can sit again passively on the sidelines and collect my, mailbox money for lack of a better term. And so that model really has served me very well. I love what I do at NewView, serving the self-directed IRA customers, and it's very aligned with my own investment portfolio. But that's really where my passion lies. It's bringing awareness to how this, powerful but underutilized tool can really help accelerate people's retirement growth. And so I'd rather spend my time doing that than managing active properties and deals.
Yeah, it's kind of funny. My path was, going and actively investing in rental property. And, there's something to be said about it, but it is certainly not the easiest way to get into investing, right? There's a learning curve. You've got to, learn how to deal with contractors, learn how to make sure that you get the place rented out quickly. Then there's the repairs and, just tracking everything. there is a much easier way by investing passively. And quite honestly, you get an opportunity to invest in much nicer assets in most cases than you could if you did it individually. Just because of the down payment factor, you have an ability to buy into a larger syndication that
Mhm.
could be a multi-million dollar property.
Yeah.
So
The other thing is, diversification is critical in any investment portfolio, whether you're investing traditionally in stocks, bonds, mutual funds, or into alternative assets. And I think, one thing that people forget about, real estate investments and alternatives in general is that you can diversify your portfolio. One thing that I realized very quickly is that I know my immediate area. I know Florida and the southeastern United States. It's because where I grew up. It's where I've
Mhm.
stomped around. It's where I know. But deals are happening in Texas, in Virginia, in Arizona, and I'm not familiar with those markets. And the reality is, I have now the ability to diversify across geographic areas. I also have the ability to diversify across property types, right? Because I'm not an expert in self storage, not an expert
Right.
in industrial, and also large scale multifamily, right? So the reality is now I can diversify not only across geographic regions, but also property type, and so hedge my bets against a whole bunch of economic factors, existential to our investment decisions, as a way to stay diversified. And so I definitely see it as a great way to, still participate in the real estate. Again, like you pointed out, I think, acquiring obviously a bigger and better asset than we otherwise could by ourselves is super critical to that as well. But I've seen great success in the partnerships that I've had, in the investments that I've made. And so it's been an easy decision to keep doing it.
Yeah, yeah, for sure. Well, tell us, Steve, about New View Trust. What does your company do? What kind of, the more I hear about self-directed IRAs, there's variations and there's nuances within it. So talk a little bit about your product and maybe give us an overview of maybe some of the differences between the
Yeah.
different options.
Yeah, Keith, thank you so much. So New View Trust is an IRA custodian, or custodian in general. We were formed 20 years ago to service those clients looking to use their retirement funds to invest in alternative assets. So we help our clients retire better every day by investing into real estate, cryptocurrency, precious metals, and really any form of alternative asset that you can think of. Without getting too granular, the IRS really only prohibits you from investing in two things: it's life insurance and collectibles, and everything else is fair game. So all these private placements that you hear your millionaire friends or Warren Buffett talking about, now you have access to through this vehicle. Self-directed IRA is really just like any other IRA. It comes with the same tax advantages of investing either tax-free or tax-deferred, but you now have wider access to options. So you may have an IRA with Charles Schwab or Fidelity, or be familiar with those options that they offer. Most of those custodians, if not all, will limit you to a certain, what I call, menu of options. With
Uh-huh.
NewView, your menu is limited simply by your investment appetite, what investments you can identify and bring to the table. And so that's super exciting. But yes, it's a powerful but underutilized tool. And every day we're just bringing more and more awareness to kind of what people can do with it.
And can you maybe explain maybe how you fund one of these to begin with? I know a lot of times folks have moved from one job to the next, and so they have the ability on maybe one of their older 401ks to roll it over.
Mhm.
But is there an option also to kind of start from scratch if maybe you've been employed with the same employer for quite some time and your money's kind of locked up with Charles Schwab, for instance, which is my case, and I can't really roll that over while I'm still employed with the current employer. So,
Yes. So just to preface this, NewView does not operate as a financial advisor, and does not,
sure.
please don't take anything that I say to be financial advice. But self-directed IRAs are an easy tool that are easy to use. It's never been easier to get those accounts funded and utilize them to your advantage. A couple considerations: that most of the clients that we work with do come to us with a previous employer 401k or some funds they've already contributed to a qualified plan. But it's important to know that, a self-directed IRA is not about having a fortune to begin with. It's about starting where you're at and having the wisdom to really grow it into something more, right? And so whether that's, $5,000 that you contributed to some 401k years ago, or it's $100,000 that you've contributed to a previous employer 401k that you're now having access to because, you're no longer employed and you're moving on somewhere different. Or maybe you were a savvy young professional that started a Roth IRA young and you've been contributing to it for many, many years. You didn't know the possibility of investing, that those funds can be invested in these alternative assets. Your eyes have been opened, and now, where are we at? And so, I would definitely say consult on any specific strategy. This strategy may not make sense if you do not otherwise have these funds in your account. You're on the older end of the spectrum. If you're younger and you have a lot longer to contribute, make those things grow, maybe. But the true power of these accounts is compounding money that's already in there, and growing it tax-free or tax-deferred. So, Keith, to your point, it's very, very easy to move money over. Let's take an example where you are leaving your employer and now your 401k is eligible for a rollover. In that process, you would contact us at NewView. You'd let us know, hey, Steve, I'm leaving my current employer. My 401k will be eligible for rollover at that time. I want to move it into a self-directed IRA. What are my options? And again, without getting too granular on all of the accounts that we offer, NewView is a custodian of retirement accounts. We do custody traditional and Roth IRAs, but we also custody employer plans as well, and specialty plans like HSAs and ESAs, all of them which can be used to make these investments. Once we've identified what vehicle you're looking to open up, whether again it be a traditional or Roth IRA, any of the employer plans or specialty plans, then we can determine how we move that money over. But it's usually a pretty easy process. You would tell your 401k administrator, hey, I'm looking to move my 401k funds into NewView once I'm eligible for the rollover. They say, okay, is your NewView account established? If so, what's the account number? What are the funding instructions? And it takes a couple weeks and some paperwork going back and forth between both parties. But other than that, it's a very, very easy process. And then once the funds are in your NewView account, it's up to you to direct us on that investment decision, whether that be into a private equity vehicle like I described with the syndications, whether you want to loan your money on a note, whether you want to buy precious metals like I mentioned, or cryptocurrency. Again, that decision would be up to you. And then we would help facilitate that process. But the 3 steps, just to summarize what I said, start an account, fund the account, and get those funds placed into your investment.
Okay. And you mentioned several different types of accounts. Can you maybe take those one at a time? And for the benefit of the audience, just kind of, talk, okay, in this scenario, this is kind of the distinguishing difference. And here are the circumstances in which maybe that would be the best account for you, or this one, and so on. Do you mind doing that with us?
Yeah.
I'm trying to learn more about this, just like everybody else. So I know if I've got questions on it, so does the audience.
Yeah, sure thing. And I'm happy to do it. So at NewView, we really have 3 tranches of accounts. Those are going to be your standard plans. So that's your traditional and Roth IRA. So a traditional IRA is an IRA that you contribute to with pre-tax dollars, meaning that you don't pay tax on the money going into those accounts. The tax that you receive on investments and any gains that you make within those accounts are deferred until retirement age, which is defined by the IRS as 59 and a half. At that time, you can then take the money that you've saved in those accounts. You would pay taxes. But anyway, you're able to grow your money tax-free. Then we have your Roth account, or your Roth IRA is contributed to with post-tax dollars. So you've already paid money you've already paid the taxes on the money going in. And as a result, you would never pay taxes on that money when it comes out. So any gains realized from your investments are all growing tax-free. And at the time that you're 59 and a half, any money sitting in that account can be distributed to you 100% tax-free. So when considering what account to open up, it really depends on your investment philosophy, whether you want to pay on the seed or the crop. I'll tell you personally, I have a Roth IRA, and that's how I started my investment journey. I don't really believe in the traditional account, not because it doesn't provide great advantages. It's just that none of us have a crystal ball. None of us can predict what the tax code or the future of our economy is going to look like in 20, 30, 40 years when we're actually able to cash in on these accounts. And so for me, I'd rather hedge my bet, pay my debt to society now, So when it is time to cash out, I don't have to worry about any additional logistics. I've already paid the piper and I'm ready to just go put my toes in the sand, kick back with my umbrella drink and not think of the rest of the world again. So that's kind of where I'm at. I have a Roth for myself and my son I contribute to, and I'm sure we can have a whole discussion about, opening up a Roth for a minor child, which many of our clients do. But yes, I have a Roth account. I encourage anybody that's young and has time, a Roth is the way to go. But those are the two, standard plans that we offer. And again, consult a CPA, consult your attorney, anybody that you receive financial advice from on which is the best for you. And then we custody employer plans. So the IRS set up the IRA to benefit all of us, but they've gave extra benefits to those people that own businesses because they're perceived to be contributing more to the economy, society, et cetera. They're employing people, through that employment, through their other business activity, they're stimulating the economy. And so we're going to incentivize those business owners by allowing them to save more for their retirement than maybe the average folk. And so these accounts are set up in a way to really maximize contribution amounts and then also provide some other advantages. So the solo 401k is the first employer plan that we sponsor. And that solo 401k is for solo entrepreneurs. So those are independent business owners that don't employ any common law employees or don't have any common law employees. And now the definition for what a common law employee is changes every year. So definitely check the most recent IRS interpretation, but essentially the IRS defines it as somebody who you don't have direct control over their day-to-day job responsibilities, right? So let's say, your wife is helping out in the business and she does some bookkeeping on Tuesday and then some marketing on Friday. And then she does a little bit of organizing the warehouse on, the next week. You don't dictate her day-to-day responsibilities. She's just really helping out. She's not considered a common law employee. Somebody then made a designation that if they work less than 1,000 hours, they're not considered a common law employee. And so the IRS put that in there, but then took that out. So definitely, again, look at the most up-to-date interpretation of what that is. But you qualify for a solo 401k if you are a sole proprietor, a solopreneur, and you have no common law employees. The solo 401k, like I said, allows for higher contribution limits. So all of these accounts have contribution limits, meaning you have a limit on how much money you can actually put into these accounts on a yearly basis. For those standard plans that I talked about, like the traditional and Roth, this year the contribution limit went up to $6,500 a year for each of those accounts with an additional $1,000 catch-up contribution after the age of 55. So if you are under 55, then you can contribute $6,500 a year to those accounts. If you're older than 55, you can contribute $7,500 a year to those accounts. So then here's the beauty and the benefit of a solo 401k for, again, those solopreneurs. The solo 401k allows for contribution limits as high as $66,000 a year.
Wow,
Now,
huge difference.
Yeah, a huge difference. Now, there are some caveats with that. You can only contribute up to 25% of the business income. And then the rest you're contributing to as basically, an employee contribution. But your business has to make a certain amount of income for you to be able to contribute the maximum amount to that account. And then you also have to be receiving enough in income from your business to also contribute the maximum amount. So just because you can contribute $66,000 a year, there are some caveats and some contingencies. Your business has to be producing income north of $300,000 a year, which doesn't seem like a lot for most people, but for many people it is. But I think it's north of $300,000 a year or something like that for it to really maximize on your contributions. But for business owners, there's also other incentives. You can take a loan from a solo 401k, right? So we know that there's always uncertainty in business, and some years we can experience down cycles, but you can actually take money from that account to basically bridge the gap in those down cycles. Now, the caveat there is that you have to pay that money back with interest, but you're paying yourself back in that case. So you're able to borrow that money tax-free, right? And at really, really low interest, right? You have to pay yourself back and you have 5 years to do it. So pretty flexible term for anybody in a more desperate or immediate need for emergency cash for their business. And then without getting too specific on it, because I don't want to confuse people. It's something that they should be aware of, but not something that they should freak out about. But UBIT and UDFI, so that's unrelated business income tax and unrelated debt finance income tax, are two taxes associated with using leverage to buy real estate, and more specifically, using your IRA to invest in deals that involve leverage. Those taxes can be avoided when investing using a solo 401k. Now, for the traditional and Roth accounts, again, definitely make sure that you're aware of that tax, because it's something that you'd be charged if you're participating in an opportunity like that. It's typically a nominal tax that really doesn't eat into your return that much. And it may be something that your CPA or your attorney can figure out a way to exempt you from anyway. But with the solo 401k, it's an absolute exemption. You would never pay that tax. And that's just another benefit of the solo 401k. So there are many benefits to the solo 401k. Again, you have to qualify for it. So that's why we don't really lead with it. Our core product is going to be those standard traditional and Roth accounts. But we do have the solo. Another option is the simple IRA. So it provides a similar contribution limit, a lower contribution limit. It's $17,000 a year, with an additional $5,000 a year catch-up contribution after the age of 55. Now, that one is intended for those employers who have employees. And so it's a way of basically setting up like a pension. There are no additional benefits that come with that. No borrowing, no tax exemptions, nothing else. It's just basically a retirement plan for your business. Then you have a SEP account. It's a simple employer pension plan. So it's essentially another vehicle, right, set up for your employees to be able to save for their retirement. Caveats here, or benefit here, is that you can contribute up to $66,000 a year to that account. So that's, again, the same contribution limit as your solo 401k, much, much higher than those standard plans. You don't get the added benefit of being able to borrow against it. You don't get the added benefit of avoiding UBIT or UDFI, but you do have the benefit of offering this to your employees, qualifying with employees. One caveat is that whatever contribution you make for yourself, you also have to make for your employees. And to be clear on that, that's your percentage of ordinary income, right? So if I'm contributing 10% of my ordinary income and I make $100,000, I don't have to make a contribution of $10,000 per employee, right? I have to simply make a 10% contribution on their ordinary income. But it has to be the same match. It's what they call a safe harbor. So that's the only caveat with that. You have a higher contribution limit. You have the ability to put this money away and really kind of accelerate the growth because of that high contribution limit. You give your employees the option of setting up a retirement account, but you also have the obligation of making a contribution that at least matches yours relative to their ordinary income.
Okay.
And that's all the employer plan. Go ahead.
Yeah, and maybe just so just kind of to sum up, you've got the traditional and the pre-taxed Roth IRA. You got the traditional, which is pre-tax, and then the Roth IRA, or vice versa. Roth is pre-taxed, right? And
you pay the taxes on the money going into a Roth, and then you pay the taxes, or you don't pay the taxes. Taxes are deferred on a traditional account.
Right. Okay. And the limits on yearly contribution, $6,500. Obviously, there's that $1,000 catch up once you're over 55. You got the solo 401k with the 66,000 contribution. If I'm understanding that being the word solo, right? You don't have any employees on this one. What if you're a married couple filing jointly? That part maybe doesn't matter, as long as, like, say my wife works for whatever, and then I'm the solo entrepreneur. I still have the ability to do as much as 66, again, depending on my income, right? Because it may not, you're not going to be able to have one of these businesses where you write everything off and still be able to contribute that. So you're going to be paying your taxes. Yeah. Okay.
Now, I should clarify, because I guess I gave a bad example saying your wife was doing these things for you. Your wife can be an employee of the business. She's a business owner with you. Then that's totally fine. She wouldn't be considered an employee in any case. She would always be an owner of the business, and more of like a plan participant or a plan sponsor than a plan participant, right? So no,
Okay.
that would be totally fine.
And what if you had, and I don't mean to get granular on this, but I've had a couple folks on talking about this, and these are just questions that I'm like, next time I'm going to ask
Sure.
ask this, right? So what if it's you and your wife, and that's the case with my wife and I for our business. We work together on it, so we're both owners, so we could do the solo 401k. But what if we have 1099 employees? So they're not W-2, they're 1099. Are we still able to do that, or is there a distinction between that?
Yeah. So again, I would definitely encourage you to reach out to like an attorney, and I can happily recommend one that we work with that could give you that advice a little bit more specifically. Because again, the
Sure.
IRS's definition of a common law employee changes pretty frequently, but
Okay.
it has nothing to do with 1099 or W-2. It's what they call common law, and the common law employee definition again, it really states, and I guess I can read it specifically. Anyone who performs services for you is your employee if you can control what will be done and how it will be done. So like I said, let's say, your friend comes into the business and, one day they help with marketing and another day they say, oh, the, warehouse is disorganized, so I'm going to clean up the warehouse. And they're just doing things to support the business and help the business. They're not considered a common law employee. But if you told them,
Okay.
hey, I want you to come in and work for me as a marketer, and every day you come in and you run our social media and you do this and you do that, that's kind of where the IRS draws the line. Um,
Okay.
so yeah.
Yeah, no, that's interesting. Okay, and then the simple plan, I believe you called it.
Mhm.
There's the SEP plan and the simple plan. The simple plan, $17,000 a year, with a really nice catch up of 5,000. So tell me just one more time, what scenario is that? That's somebody that has employees.
Correct. Yep.
Okay.
That person has employees. The simple is an option of setting up this plan. It gives you higher contributions than your traditional or Roth account, but it doesn't require you, and it also gives you the ability to allow your employees to participate in the retirement plan, but you're not required to contribute on their behalf.
Okay, and then the SEP is one of the main differences there. You are required not to give exactly what you're contributing, but from a percentage standpoint, and you gave the example of 10%.
Mhm.
Um, and so they just need to have that ability as well to have 10. Now, do you have to contribute on their behalf? You have to contribute on their behalf for the SEP. Yeah.
Correct. Yeah.
Okay.
Like irregardless of what they do, it's called a safe harbor. Yeah.
Okay. Like a matching, like, my current employer does matching, to my 401k up to a X amount, but something similar to that. Maybe not exactly, but you're contributing as well.
Yeah, so that's the thing. In this instance, you are making that contribution to their account regardless of what they do. So let's say I'm your employee and I don't want to contribute to my retirement. You still have to make a 10% contribution to my retirement if you're making a 10% contribution to your retirement. So unlike an
Okay.
employee match where, they're kind of matching funds that you put in and making sure that your
Right.
interests are aligned and incentivizing you to do this, you are you the business owner are incentivized by higher contribution limits and access to basically deferring the taxes on the investments in these accounts, but you have to contribute to your employees' retirement. The whole system is really set up for the government to not have to subsidize our retirement, right? The IRA was
Yeah.
originally developed for us to basically save for our own retirement so that it would take place of the pensions, and the other vehicles that existed for corporations and the government to basically fund our retirement. So the ultimate goal is to make sure that the government has no responsibility in that. So we're going to provide you with incentives, i.e., higher contribution limits, access to other investment options, deferring taxes, but you have to make contributions on the behalf of your employees as well. And so that's the only caveat, the only difference is that regardless of what your employee does, you still have to put money away in their retirement account at a relative cost to what you contribute. Again, the 10% is just for ease of math. But I mean, you can contribute 3%, 6%. The rule is just that if you contribute 6% of your income earned, then you also have to contribute 6% of whatever their ordinary income is. And again, it's not based on your income or the business income. It's whatever they took home,
Percentage. Yeah.
that year. Correct.
Yeah, I understand. And then on that one specifically, I think it was the SEP, and maybe it was the simple as well. But neither one of those two are you able to take a loan against the amount. Now, one question I have on the solo is you mentioned being able to take a loan. Is it capped at the 50,000, similar to I just keep going back to the one I'm more familiar with, which is my employer one. I cannot take more than 50K, and it has to be, if I'm paying it back in portions, you're not able to you can't just pay it off and then turn right around and borrow 50K again. You got to, wait on basically how and when the year from that time frame was paid off.
Yeah, no, thanks for pointing that out. You absolutely, yes. So it's capped at $50,000 or half of your business income. So again, if you don't make, enough to support the $50,000 loan in income, then you can't take the whole $50,000 out, right? But yes, you can take up a max of $50,000. You have up to 5 years to pay yourself back at the prime interest rate. There's no recommended installment. There's no required installment. There's no amortization or anything like that. You have 5 years to pay it back at the prime interest rate, and that's it. Has to be paid back in full, or you receive tax penalties, from the IRS. But yes, it is capped at $50,000.
Okay. No, that's great. So, Steve, I appreciate this. This has been really good. I know we probably went down rabbit hole after rabbit hole that maybe you weren't intending to, but you really cleared up quite a bit for me, and so I know you did for the audience as well. But let me ask you this: is there something that I haven't asked about New View or about self-directed IRAs that you feel is important for the audience to know?
Yeah, no, like I said before, self-directed IRAs are not a get-rich-quick scheme or a get-rich-quick tool. They're a grow wealth steadily tool. And, the important thing that I would encourage everybody to do is just really assess where they're at in their investment journey. Understand that as the investment landscape continues to change, it will only become more and more accessible. So if you haven't invested already, you need to take the leap and start making your money work for you. A self-directed IRA provides a great vehicle for you to do that, either tax-free or tax-deferred, without limiting you to, public securities, that other custodians limit you to. But no, I would definitely encourage you guys to get in touch with us here at New View if you are thinking about this option. We're happy to act as, more of an educator, providing you with answers to all of the questions that you might have so you can make a sound decision. The benefit of the internet is that this information is more accessible than it's ever been. What's funny is that, when the IRAs were established in 1974, the provision of that code included the ability for people to take their money and place them into these private funds, deals, and opportunities. But many people just weren't aware of that. It wasn't really until the last 10 years when, light's really been shed on it. And we've really started seeing, much bigger increase in popularity. But no, definitely encourage them to just get in touch with us, newviewtrust.com. We've got a plethora of webinars and podcasts and live events and things like that all talk about self-directed IRAs, the technicalities, and if there's any other in-depth questions, so we're happy to answer them.
Yeah, that's great. Thank you, Steve. Really appreciate it. This has been enlightening. Let me ask you, when you're not, I'm going to ask you a couple questions, but when you're not working and doing the New View Trust stuff, what do you like to do on your free time? I know you had mentioned that you're a single dad. Are you still just one child so far?
I am one child, my baby boy, Steve. He is, my pride and joy, but a handful for sure. Sure, every parent knows that struggle a little bit. I'm very blessed and very fortunate. He is a very easy child relative to some others that I've had, the pleasure of dealing with in my life. And no, we really enjoy spending time outside. So we live in an area of Florida where we're very close to the water, but we're also far enough inland that we can experience some of the other ecosystems that Florida has. So we've got mountain bikes and we've got a kayak, and we love to do those things. I'm an avid reader. I mean, you can see behind me, I've got 5 or 4 new books that I just got. To start this month, I typically read about 5 or 6 books a month. So, any free time I have, I like to read.
Awesome. Awesome. Well, then you're going to love one of my next questions. So, but before we get there, just maybe some advice to somebody who's just starting out in their investment journey. What advice would you give them?
Yeah, if you're just getting started, talk to people who have done it before, talk to other people that are just getting started. You're not alone. I'm working on a book right now called Investing Beyond Boundaries, investing in real estate for young professionals. And we touch on a lot of topics, and one of them is limiting beliefs. And when I first got started in this industry, or on my journey towards really changing my retirement, I didn't know what to do. I mean, I just came out of college. I was looking to establish my life and my career. I had a child, and shortly thereafter, myself and his mom, split. She disappeared, and long story longer, without getting again too detailed, I didn't know what I was going to do. I had no money, had no, real experience. And so it took me a while to get past that limiting belief. But I would just say, invest in yourself. Again, self-directed IRAs and investments in general aren't about having a fortune to begin with. It's about starting where you are with what you have and having the wisdom to grow that into something more. And so all I would say is, take the leap, get out into your community. There's plenty of people out there. That's, again, one thing that we didn't really touch on is like how you meet these people, but just network. There's a lot of local communities like RIAs. I know I talk a lot about real estate. There are so many other areas of alternative assets. We could spend a week talking about them. But specifically, I focus on real estate. And there's, real estate investment associations in pretty much every local municipality, county, or area. There's online forums and groups. And so just get out into the community, learn as much as you can, ask questions, be curious. Don't be afraid to, admit what you don't know. And that's one thing that I had to learn. I always, I was always embarrassed to not know, right? I didn't want to be perceived to be the young, ignorant, naive kid that didn't know anything. The reality is everybody starts somewhere. And if you don't ask questions, you're not going to ever open up the door to learning more and to getting to that level that you want to be at.
Yeah, no, that's great advice, Steve. And then what about a book recommendation? I asked for the audience, but I also asked for myself. I too, I'm more of an audible guy versus a reader. I like to run, and so this question is just as much for me as it is for the audience.
Yes, well, I'm gonna give a cliche. People may have heard of it. It's called The Energy Bus. I don't know why, for the life of me, I'm blanking on
John
the
Gordon.
as I look.
John Gordon, I believe.
There you go. Yeah. So, the book basically is an analogy of this gentleman who breaks down on the side of the road. A bus drives by and is his solution for the day. He gets on the bus and, basically on the bus, he meets a bunch of different characters. The moral and essence of the story is that energy is very, very important and crucial to teams, organizations, and just your life in general. They encourage you not to be what they call an energy vampire, but more be a CEO, like that chief energy officer. Really infusing energy into everything that you do. And, that's been something that has held really near and dear to my heart. I try to approach everything with that same sense of, youthfulness and energy. And I think that it's really served me very, very well in my career, not just in dealing with the teams and people that I work with, but also the investors that we service and some of the other partners that we have throughout our business. And so The Energy Bus, John Gordon, if you haven't read it, is great.
Yeah, for sure. For sure it is. It's funny you say that too for organizations, because when I first kind of came over a little bit of a larger team, that was a workshop that we did. It was amazing, and it was something that you could drive the team the entire year with, and just and had a lot of really good recommendations. He's got some other really good books as well. But yeah, I love that recommendation. That's the first time somebody's recommended that on this show. And so I highly recommend it as well. Steve, I appreciate it. I think you've added a ton of value to our listeners. Like I said, I know we went a little deep in some of those various types of 401ks and retirement plans, but I think it was well worth it. And you've certainly opened my eyes to quite a bit. So I know you have for the audience as well.
Well, again, Keith, thank you so much for having me on. Again, it was a pleasure being able to share with you and your tribe that's learning to, get better, with their investments and how they're thinking about money. And I think it's super critical and important to educate people and bring awareness. And so thank you for providing people like me a platform to come and talk about what we do and tell our stories.
Absolutely. Thank you, Steve. Okay, we're going to call it a show. Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.